Hello and welcome to this quarterly infrastructure update. My name is Mark Jordan, Head of Retail at Magellan, and today I'm joined by Ben McVicar, Portfolio Manager in Magellan's infrastructure team. Welcome, Ben.
Thank you.
Infrastructure assets have been under some pressure this year, and this has been reflected in Magellan's infrastructure fund performance. Could you perhaps step us through some of the drivers of this performance from an absolute sense, and then perhaps talk about some of the portfolio positioning that has also impacted on fund performance?
Yeah, sure. So what I might do, just appreciate this information well, but what I might do is just start with the context of how we actually approach investment in infrastructure, and that will provide context really for how we think about the relative performance. So when we invest in infrastructure, really what we're trying to do is find assets that one, deliver essential services into the communities in which they operate. That's really important because if you get that piece right, you end up with really reliable demand. You end up with effectively a set of assets where it doesn't matter what the economic conditions are, people keep using their services, running water, electricity. The thing that I'd say we do, and very intentionally, is try to reduce the risk, and we very much place ourselves on the conservative side of what we view as infrastructure. And so what that means for us, and I'll call it the ones that impact on performance of late, is that we, one, try to avoid any area with too much sovereign risk, any area with too much competition exposure, but really importantly for today's discussion, we try to avoid any areas where we see material exposure to commodity prices, i.e. Those businesses where when you see oil prices go up or gas prices go up, the margin and financial performance of that business improves. So now sort of move into the performance part of your question there. In absolute returns, what we're seeing at the moment, it's really about, we've seen a period of time recently where interest rates have moved up really significantly. And obviously in the short term, what that's meant is that all of the long duration, more defensive type assets have had that as a headwind during that period. So certainly that's been an impact on that. Now, we've seen this in the past. In the past, we've certainly seen periods where we've had, if you go back to even as far back as 2013, you had the taper tantrum, where effectively long bond yields went up 90 basis points at the time. We've had that in 2016 after the Trump election, or leading up to the Trump election. And again, interest rates went up around 90 basis points, and you saw infrastructure decline 5-10% in those sort of periods. But what we saw then was that infrastructure tended to recover in the ensuing periods. What is different this time is the magnitude of the inflation increases, as well as the fact that we haven't seen interest rates then revert back down to a low level. They've continued to increase. There's been a more sticky inflationary outcome. And so that's obviously acted as a bigger impact on infrastructure performance. Now, when we look at what's actually impacted the portfolio from a negative sense in the last 12 months in particular, it's been really two areas. One is the very defensive US utility companies, as well as the communications infrastructure companies. Now, both of those have been impacted because investors have sold off some of those defensive type assets. On the other side, though, the portfolio have had probably better than expected performance out of things like airports and toll roads more recently. So for now, that's been a headwind to performance. The thing I'd add there is that the underlying businesses continue to do what we expect them to do. Now, so that's the absolute returns piece. The other piece is relative returns. What we've really seen in the last a few years, probably the last 3 years, has been, I mentioned before that we try to avoid anything with too much commodity price exposure. Really what we've seen in the last few years is a really strong run up in energy prices, particularly post-COVID and now with the Ukraine invasion continuing to constrain energy markets. That's really benefiting a lot of the companies that we exclude from investment in our universe, but are in commonly held benchmarks. Now, I do just want to highlight as well here that when we build the infrastructure strategies, we do this in a benchmark unaware manner. So we're not focusing on what's in the benchmark, but obviously we're happy to provide our analysis. But certainly that piece on energy has been the biggest relative return headwind in recent years, as we've seen effectively those companies perform quite well in the benchmark. Now, when we sit back and look at this, are we looking to make any changes to how we invest and operate in the space? Absolutely not. I think if you start making changes, that's how you end up getting behind the ball in this type of situation. So we're not looking to make any changes to the approach, but that's not to say that it's any more enjoyable when you see the benchmark getting the benefit from that.
You mentioned the impact of higher interest rates. Importantly, what impact are these rates having on the financial performance of the underlying portfolio companies?
When we think about the impact on the underlying companies themselves, and this is probably the part of the story that I prefer to focus on, because obviously short-term share prices are going to do what short-term share prices do. The focus for us is really what the underlying businesses are doing over time. And certainly what we're seeing is, the vast majority of the companies, when you have a circa 30 stock portfolio, you're always going to have one or two that aren't doing exactly what you like, but the vast majority of companies are delivering the cash flow growth. And I think I'd say on average doing better than we would expect, particularly you had things like airports coming through stronger than expected. Where I think this question probably has the most relevance is really on the balance sheets of these businesses. So obviously when they're all carrying reasonable amounts of debt, how does that actually translate back to financing costs for these operations? The thing that's probably less well appreciated in this space is that a lot of these companies have been terming out their debt. And so whilst you're going to have debt maturities coming through and you are going to refinance into a higher rate in the marketplace, it's going to take a while. And so what this probably means in practical terms for these companies is that you have a headwind to growth in earnings or cash flow, but it's not unlikely to be an immediate reset and impact in the businesses themselves. Now, that's the balance sheets. There's another part of this whole story that I think gets reasonably technical, and it's probably bread and butter for the way I look at the world. But when you actually think about a lot of the companies in our space, they actually have earnings that go up as interest rates go up. So a lot of utilities, for example, they have the ability to pass through higher funding costs onto customer rates. And in fact, a lot of utilities in places like Europe and UK and Australia, the regulatory regime actually allows them to earn more when interest rates go up. The regulator says rates are up, therefore the fair return has gone up. So earnings go up in that environment. And then even toll roads. Interest rates have gone up for a combination of reasons of late. One is real interest rates have gone up, but also inflation's gone up. And so to the extent that inflation is going up, toll prices actually escalate by that inflationary increase over time. So there's reasonable protection on that side of it. So when we sort of step back and think about the fundamental performance of the businesses, it looks pretty reasonable to us. Now the sort of Goldilocks scenario amongst all of this, I don't like to get too focused on one particular positive outcome here, but obviously if you did see interest rates, inflation receding, what that would mean for a lot of these infrastructure and utilities businesses is you just had interest rates go up and inflation go up. So you've had toll prices increase, you've had returns being increased, but on the other side of that, if you saw that interest rates start to come down, that would mean they're not refinancing onto the higher rates. So potentially, there's a scenario there that looks quite reasonable for these companies. But as I said, that's not the scenario we're planning on, and certainly that you could see a lot of other scenarios play out as well.
Onto the portfolio. How is the strategy currently positioned? Given we are now largely through the COVID-related impacts, where are you seeing opportunities in the market for infrastructure?
Yeah, so a couple of things to sort of maybe call out at the start of this is that one, what we've seen in most recent months has probably been more broad-based selling. When as interest rates gone up, we've seen assets sold irrespective of really how we see the impact on interest rates in those businesses. And the other thing as well I'd probably highlight here is that when we look for value in the space, we're using current interest rates. We're not making assumptions that interest rates are going to go down and therefore there's good value in the space. We're using what we see in markets and we're reflecting that in our valuations. So this is not going to look entirely dissimilar to prior updates that we've had on the portfolio structure, and we don't tend to change it that quickly. But one of the largest holdings for us is in the toll roads space, at around a quarter of the portfolio. Those businesses, the thing that we find particularly attractive is one, valuation, as you sort of said. The other point as well is toll roads have really good inflation protection. So these businesses, you tend to find that the inflation protection is automatic. So quarterly, annually, you get a CPI pass-through or a percentage of CPI onto tolls. So it gives you good protection for inflation. Now, the valuation opportunity there seems to be as much of a thing about really just the time it's taken to the market to come back to these assets post-COVID. And so maybe there's two examples in that space that are in the portfolio and larger holdings for us. One is Vinci in France, a major operation with the large toll roads in the interurban network in France, as well as the Portuguese airport system, ANA Airports. So they're a nice operation, and what we're finding at the moment is a lot of political and regulatory noise about governments trying to apply taxes to concessions there. That creates opportunity because obviously the reason we're there in the first place is because we only invest in jurisdictions where we're confident in the rule of law and the strength of the concession contracts. And so that creates an opportunity there. Another one in the portfolio as well is Ferrovial. Ferrovial is a European domiciled business, but with assets that are primarily in North America. Their most important assets, probably the 407 ETR, which is a Toronto-based toll road. Really attractive road, but obviously it's taken a while to come back out of the recovery post-COVID. And the interesting thing there is once they can start to get their traffic, and this is a very long, decades and decades left to run on this motorway, they'll eventually get their traffic back to 2019 levels, and at which point they can start to push through toll increases, and there's a really interesting opportunity there. Another piece in the portfolio that remains a significant holding for us is in the electric utilities. So what we call our integrated power and transmission and distribution is probably just under a third of the portfolio. This is a thing that we've talked about in the past, which is really about the short term is always going to be all about interest rates and the share price reaction to that, and we try to look through that, and the opportunity that we see is really around the long-term structural decarbonisation trends. And what you see, most of the solutions to decarbonisation are really about increasing the use of electricity. And what that means is these companies, these electric utilities, are going to have to be the platform to enable that. And so what we're seeing is, maybe an example here is IRENA have put out a forecast that says to get to net zero, electric utilities or electricity goes from 19% of final energy demand to 50%. So you can see a very material increase in the market share of electricity in economies. And so what that means is these companies have trillions of dollars of capex in front of them, and obviously their business model is spend a dollar and earn a return on that dollar. So there's an interesting opportunity in that space. And maybe one of the last opportunities that we see is really in some of the, what you typically consider being one of the safer parts of the market, so the water utilities. But there's been a lot of political noise, particularly in the UK, and that's really opened up a valuation opportunity when you couple that with the market reaction to interest rates. So we're seeing some interesting opportunities there as well. But like I said, in the near term, I think the noise is going to be around interest rates and inflation, but there are a lot of these opportunities that are popping up as well.
One of the potential scenarios we see going forward is an economic slowdown. How would infrastructure assets behave in that environment?
It's an interesting one because I think when you actually step back, I started off this conversation today by really talking about our approach to infrastructure and why you'd invest there in the first place. And the nature of what you're doing is invested in essential services. And these are the types of assets that in an economic slowdown should do okay in that environment. And so, things to the extreme, running water, electricity, gas for heating, all those goods are going to remain in demand. But then as you move across our sort of risk spectrum in the infrastructure space and you get to airports, toll roads, those types of businesses are actually far less sensitive than I think people might consider. And in fact, when you think about some of the companies in our space, so I think most people consider that utilities, they're going to be quite defensive, and you might get a bit of a slowdown in the demand for those assets. But the reality is the regulatory backstop they have means that you've seen periods of time when you've had the GFC, COVID, the financial performance of those businesses has been remarkably strong. But it's really when you then move to things like toll roads and airports, they've actually remained remarkably resilient in that environment. I think there's probably a sense that what we've just experienced in things like airports with COVID is going to be a reflection of what we're going to see in an economic downturn. I think that's absolutely not the case. The economic sensitivity is very different to the COVID experience, which is much more akin to a natural disaster. So I think utilities and infrastructure assets have a place in portfolios, which is really around that defensive quality. Obviously, the conversation right now is probably more about the other macro components out there, but the defensive qualities are very strong.
Thanks, Ben, and thank you for watching. If you have any questions following this update, please don't hesitate to contact one of Magellan's distribution team to have a conversation. And also, please feel free to share this video with clients or colleagues. Thanks, and see you soon.